Well, the tech retreat coming as the narrative on AI faces some questions. One example is Oracle. That stock was down for a fourth straight day. It closed the week 8% lower. Oklo is another example of the AI rethink. The nuclear stock has had a big run, but fell nearly 20% this week. Despite the recent weaknesses in AI names, our next guest cites the AI trade as a reason to stick with U.S. equities. Joining us now is HSBC Chief Investment Officer Jose Rasco. Jose, happy Friday. So I guess a big question perhaps on investors' minds is, why isn't this AI run like the dot-com run before? Yes, the internet was ultimately a big deal, but we had to go through this, cycle of doubt that actually took down quite a bit of the market.
Look, you're absolutely right, John. And as you can see by my hairline, I'm old enough to remember that. So I think if you look back in the 90s, I would equate the first gen of generative AI is sort of like putting the phone, the modem together with the computer. We're at that level. I think the next evolution of AI, that where it's going, and if you look at all the things that are coming in terms of working with industry and working directly, doing joint ventures with clients and helping them become more productive, that really is the future of this trade from our perspective. It's not just an AI input trade. It's more about the broader tech sector and what is going on in the broader economy and how does this create a broader market rally. That's really our perspective.
So I started the week with Jensen Huang and Sam Altman at NVIDIA headquarters announcing this huge investment of potentially up to $100 billion from NVIDIA into OpenAI, very much about the promise of the future, how this infrastructure investment would lead to all of these breakthroughs and discoveries. But is so much of that priced into so much of the market right now that there's not room for error that will correct dramatically if there's a hiccup?
Well, and you and I have been talking about this for a while. I think if you look at the market now, growth has exceeded value for quite a while, and this bull market from the early April to now has been led by growth. It's been led by the Mag 7 and led by tech, and we think we need to see that broaden out. So we think we're at the beginning of a recalibration of equities here, and given what could happen with the government shutdown next week, we think we'll see a bit of a recalibration in terms of growth value. The Mag 7 versus the forgotten 493. Don't forget, earnings for the Mag 7 are about to slow. Beginning in Q3 through the end of the fourth quarter next year, earnings are going to slow from 23 to 15% for the Mag 7. But it's the forgotten 493. That's where we need to focus. These are the companies that are going to benefit from Gen AI, the adoption of Gen AI, and the next level of that, as well as pretty straightforward comps that they should be able to beat. And I think that's where we're going to see the earnings explosion, which is from 4% in Q3 of this year to 15% in the fourth quarter of next year. So that's our bet, is the market rally broadens out from here.
How much does that bet also hinge on the economy remaining strong or resilient, or at least not tipping into recession?
Yeah, that is one of the key elements, no question about it. But I think if you look at where we are, the Fed just began a new easing cycle, right? And our perspective is that we think they're going to ease two more times here in Q4, in October and December. And the market is sort of locked into that as well. If you look at the SEP, the Summary of Economic Projections from the FOMC meeting, that's what they told us, Morgan. They're going to ease twice more this year, probably. And the labor markets have cooled enough to allow them to do it. Now, remember, on the inflation side, the Fed is battling higher year-over-year inflation. If you look at the month-over-month numbers, far tamer than they were last year. That gives the Fed some room to ease, and we still have the secular deflation from tech that has not really kicked in yet. But the other thing that they need to take into account is the fact that that 2% symmetric rate they're looking for may be tougher to achieve. If you look at the FDI that we've received in this country from 2018 to now, we're number one in the world in terms of receiving dollars and receiving assets, right? That's tremendous, but too many dollars chasing the same goods, that it may be tougher to get inflation to where they want it, but I think they would be very happy with a number in the 2 to 2.5% range.
Yeah.
Look at third quarter growth, 3.9%, according to the Atlanta Fed.